Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. The first half of 2022 has been disappointing for the stock market. The index fell around 9% during this period, and of course there are individual stocks that have fallen a lot more. In fact, a few of them are down as much as 30%, 40%, even 50% in some cases. One such stock is one of India's largest asset management firms, HDFC AMC. When I last checked on Google, the stock was down more than a whopping 40% from its 52-week highs. Now, this is quite a significant correction for a good quality stock like HDFC AMC. The company is the largest player in the industry. In fact, it's one of the largest players and has a huge growth runway ahead of it. Besides, it boasts of strong financials and a management team that's considered to be both efficient as well as honest and transparent. Therefore, is this a good time to buy the stock? Is the risk-reward equation of investing at the present levels in favor of the investors, or have weaknesses cropped up in the company's business model that are difficult to overcome? Let us try and find the answers to these questions in today's video. You see, few years back I came across a comment that I liked so much that I noted it down in my diary. It was about what drives returns from a stock over both the short term as well as the long term. Now here's what the comment was all about, that over the short term, trend matters more than value, which in turn matters more than fundamentals in terms of driving returns. While over the long term, fundamentals matter the most, followed by value, followed by trend. Over the short term, the underlying trend has a greater impact on the stock price than value, which in turn has a greater impact than the fundamentals of the stock. Over the long term, however, fundamentals matter the most, followed by value, and trend matters the least. So if you are investing in a stock from a short-term perspective, the first thing you need to figure out is whether the stock is in an uptrend or a downtrend. If it is in an uptrend, you invest, and if it is in a downtrend, you don't. Over the medium term, it is the valuations that count. If the stock is undervalued and if it's a decent stock, then that is what will drive the returns over a 2 to 3 year period more than anything else. Over the long term, however, that is a period beyond 3 years and ideally 5 years or more, it is the long-term fundamentals, that is the underlying strength of the business and its capacity to grow, its earnings, that's the biggest driver of returns as compared to the trend or the valuation. So let me sum it up again. If your investment horizon is from a few weeks to a few months, the underlying trend is your friend. If the horizon is from 2 to 3 years, it is the undervaluation or overvaluation of the business that matters. And if the investment horizon is 3 to 5 years and much beyond, worry more about the fundamentals of the business than anything else. Why am I telling you this? Because if we want to consider investing in HDFC AMC, one cannot do it successfully unless one gets a fix on investment horizon. It doesn't make sense to figure out the company's valuations or understand its long-term fundamentals if we are a trader and interested only in the underlying trend. Likewise, both the trend and the valuation should be given less importance, and the long-term fundamentals should be given more importance if we are looking to invest in the stock, at least from a 5-year perspective. In short, our investment horizon determines which of the 3 factors to give more importance to. Well, as far as this video is concerned and my own personal investment philosophy goes, I like to make an investment from a 2 to 3 year perspective. I think temperament-wise, I am more suited to this particular investment horizon. As an analyst, it is difficult for me to look beyond 2 to 3 years, and which is why for all the services that I run at Equitymaster, my investment horizon is not more than 2 to 3 years. And as we just saw, if your investment horizon is 2 to 3 years, then the valuation should be given more importance than the underlying trend or very long-term fundamentals. Therefore, if one wants to invest in the stock right now from a 3-year perspective, one needs to figure out the fair value or the intrinsic value of the company and compare it with the current price. If the stock is trading at a significant discount to its intrinsic value, then one considers buying the stock at the current price. However, if the discount is not much or if the price is greater than the intrinsic value, then one should stay away from the stock for the time being. Now, in order to find out the stock's intrinsic value, I need two things. I need the P/E ratio that one should give to the stock, plus I need to figure out the EPS or the earnings per share that the stock is likely to have 3 years down the line. Multiplying the two, that is the P/E ratio by the earnings per share, will give us our estimate of the intrinsic value of the company. Then all we need to do is compare it with its current price to check whether the stock is an attractive investment or not. Let us first find out what is the P multiple that we should give to a stock like HDFC AMC. You see, I have said this before and I'm going to say it again, that the difference between investment and speculation is one of the most underrated concepts in finance. If you have to achieve superb long-term returns, then being able to differentiate between investment and speculation is a must. Now, the interesting thing about the concepts of investment and speculation is that they can be tailored to one's temperament and investing style. What I mean by this is one man's investment can be another person's speculation and vice versa. And yet, both of them can end up having fantastic long-term track record. A classic case would be Warren Buffett and Walter Schloss. Now, Walter Schloss never believed in paying more than the latest book value per share for a stock, whereas Buffett believes that book value is misleading and he doesn't mind paying a huge premium to book value if the company has a strong moat. So what Walter Schloss called as an investment, Buffett called speculation, and what Buffett called as an investment, Walter Schloss called speculation. And still, both of them ended up having amongst the best track records in the industry. Therefore, it is entirely up to you to decide what is an investment and what is speculation, as long as your definitions are logical and have proven to work in the stock market over many years in the past. When it comes to HDFC AMC, my definition of an investment is a P/E ratio of 30x. In other words, if the stock is trading at a P/E ratio of significantly more than 30x, I will consider it as a speculation. But why 30x and not 25x or 40x? What's so special about 30x? Well, there's nothing special about 30x. As per my own understanding, it is very hard to earn market-beating returns in the stock market if you consistently pay upwards of 30x for any stock, no matter how good the quality. You may be successful a few times, but if you pay significantly more than 30 times for every stock you buy, there's a strong chance you may underperform. Now, I know what you're thinking. All good quality stocks in the Indian stock market currently sport a P multiple that's well in excess of 30x. In fact, few of them trade at a P of 40x, 50x, and even 60x, and are still considered an attractive investment from a long-term perspective. Well, as I said, one man's investment can be another person's speculation. There could be investors out there that consider giving a P/E ratio of 60x as still an investment and are even successful at it. However, I don't like paying such high P/E multiples, and therefore my upper limit for even the best quality stock is a P/E of 30x, and this is what I'd like to assign to HDFC AMC as well. Interestingly, at the time of the company's IPO back in August 2018, the stock was valued at a P/E of around 31.4x by the company and the lead managers managing its IPO. Thus, even the people who are in charge of its day-to-day operations and know the company inside out felt that the stock was fairly valued at a P/E of 31.4x. Therefore, considering all these reasons, I feel that a P/E multiple of 30x is a good multiple to assign to the stock. Okay, that was about the P/E ratio. What about the earnings now? What do you think the earnings of the company will look like 3 years from now? In fact, let me use this opportunity to give you a brief description of the business. HDFC AMC is among India's most profitable and preferred mutual fund managers. The company manages both equity-oriented as well as debt-oriented schemes. Out of its total funds under management of more than rupees 4 lakh crores, 51% of the funds are parked in equity-oriented schemes, whereas the remaining 49% are parked in debt and other schemes. The company's strong brand appeal and its distribution network has contributed majorly to its growth over the past few years. Now, here's the performance snapshot of the company over the last 5 years. Starting from top left, sales have grown at a CAGR of 7.4%, PBT at 18.3%. Its return on equity has gone down from 40 to 27 in FY22, which is still impressive. Now, the reason its return on equity is down is because it generates a lot of cash that is sitting on the balance sheet in the form of investments, and that's pulling the ROE down. The company is paying generous dividends but still has enough cash sitting on the balance sheet and dragging down its return on equity. Now, moving on to the operating profits and net profits, they have grown at 17% and 20% CAGR respectively. Now, we are in a situation where the top line has grown by 7% over the last 5 years, but PAT has grown by 20%. This means that the company's operating margins and net profit margins have expanded, and this is exactly what has happened. Between FY17 and FY22, operating margins has moved from 51% to 79%, whereas the net profit margins have gone up from 35 to 57%. Now, improvement in margins is of course a good thing. It shows that the company has cut significant costs and has become more efficient than before. However, in the case of HDFC AMC, the improvement in the margins has to do with something else. It has to do with a new regulation brought in by the regulator. As per the new regulation, commission and certain other expenses related to the schemes of mutual fund, which were earlier borne by the company, are now borne in the books of the schemes of the mutual fund. As a result of this change, fees and commission expenses are no longer a part of the total expenses of the company and are now borne in the books of the schemes of the mutual fund. The way the whole math of this works, it has led to an expansion of the margins of the company. Going forward, however, we expect the margins to stay at these levels and not improve a great deal from here. What about the top line and the bottom line of the company? Will the top line continue to grow at the 7.4% rate that it has managed over the last 5 years, or is the growth going to pick up further? And will the profit after tax and the EPS of the company grow at 20% per annum like it has done in the last 5 years? To be fair, there is immense scope for the industry to grow. The mutual fund industry in India remains significantly underpenetrated compared to global averages, despite the sharp growth in the last few years. India's mutual funds AUM to GDP ratio stands at only 16% compared to the global average of 74%. Our equity AUM to market cap was at 6% against the global average of 33%. Therefore, HDFC AMC, with its strong brand appeal and distribution network, is fully equipped to tap into this huge opportunity. Well, there is no doubt that the business has immense potential. But will this potential translate into returns for the company's shareholder over the next 3 years? Now, we know that the maximum PE ratio that we are willing to pay for the shares of HDFC AMC is in the region of 30x. What about its earnings per share over the next 3 years though? You see, as we saw in one of the previous slides, HDFC AMC has managed to grow its top line by more than 7% over the last 4-5 years. However, this was not a like-to-like comparison, as there was a change in the way commissions and discounts were accounted for in the P&L statement. You see, 5 years back, commissions and discounts were part of the expense head of the company, but now they are part of the top line. They are deducted directly from the top line if my understanding is correct. Therefore, if you do the same on the revenues for the latest fiscal, revenues for the fiscal FY18 and recalculate the growth rate, then the growth in top line comes to around 10%, up from 7.4% growth without the adjustment. Now, when it comes to investing, you have to adopt a conservative mindset. This means that barring exceptional cases, you should not assume future growth to be higher than the past growth. For HDFC AMC also, future growth cannot be higher than what it has achieved in the past. As we just saw, the company has managed to grow its top line by around 10% in the recent past, and this is what we are going to assume for the future as well. The company's net profit margin has expanded from 35% in FY17 to 57% in FY22. I don't think there is scope for the margins to expand even further from here. It will be safe to assume that margins will remain at the 57% mark. Therefore, the growth in company's net profits as well as its earnings per share is likely to come in at around 10% to 12% over the next 3 to 4 years. The company earned an EPS of 65.3 in FY22. Assuming a 10% growth rate over 3 years, the company is likely to report an EPS of around Rs 87 per share. So now we have both the PE ratio and the EPS of the company 3 years down the line. Multiplying the two, we get a target price of close to Rs 2,600 per share. This means that the stock could trade at Rs 2,600 per share 3 years from now. This translates into a return of around 12% on the current stock price of Rs 1,900 or thereabouts. Add to this a dividend yield of 2.2% every year and you get a CAGR of 14% to 15% over the next 3 years. Of course, there are a few risks to our projections. If the top line and bottom line growth does not come in, the P ratio of the company may fall from 30x to 25x, even 20x. This, coupled with a lower EPS, can lead to the stock price crashing 25% to 30% or even more from the current levels. Therefore, it is very important that investors keep this in mind. Please note that this is not a recommendation. You are advised to talk to your investment advisor before taking any decision on the stock. The goal behind this video is to give you a glimpse into how you should go about analyzing an investment opportunity and not try and make it too complex. First, it is very important to determine who you are. Are you a trader, a medium-term investor, or a very long-term investor? Once you are clear about this, you can then proceed with the type of analysis that suits your investment style. In my case, since my holding period is 2 to 3 years, I preferred figuring out the right P ratio for the stock and its expected earnings per share 3 years down the line. Once you zero in on these two numbers, you can then go on to calculate the fair value of the stock 2 to 3 years down the line and compare it with the current stock price and then finally come to any sort of conclusion. We hope you like this approach of analyzing a stock. Do let me know in the comment section, and also please do not forget to give the video a like if you found it to be useful. I will see you again next time. Thank you so much.